What's going on, guys? What's up, Carlos? Sin, what's good? What up, Val? What's up, Felix? What's going on, Natalie? What's up, Jay? Andre? Yeah, man, like gold is going crazy. What's up, Craig? Another all nighter? Yeah, gold going good, man. Sheesh. Usually this is on Sundays, but yeah, I was busy on Sunday, so I'm just doing it today. Yeah, gold is still rising. I wish I would have held my position on Friday. Yeah, Carlos, I agree. Definitely been seeing it too, like around 3 a.m. London session. Gold has been giving some really good setups. Interesting, this is happening now too. Usually we would love to see this around what's going on already. Gold pushing up like this be great around 9 p.m. Eastern, but the fact that it's doing this now, all right, let's get this started. You took some gold trades though, right? Yeah, man. I feel like a lot of I've been killing gold, man. It's just been super easy, just one sided. All right, let's get this started. What's going on, guys? So we're gonna be doing our weekly prep again. I normally do this on Sundays, but we're just busy on a Sunday, so we're gonna do it today, and it's just a weekly prep. We're gonna also go over just pretty much more from a macro perspective from the Federal Reserve, right? Just to get you guys to understand the overall direction and why. So you guys could trade with an edge moving forward, okay? Because a lot of this stuff is what, people tend to not pay attention to. But in order for you to be confident and comfortable with the trades that you take, you have to understand the bigger picture, understand why the market is moving in this direction. All right, so let's just start off with we're gonna start off with a little bit of news headlines that we had on Friday. So Friday, the video, most of y'all probably did see the reel with gold, right? Gold is a really good option when we're having headlines with tariffs, especially between the US and China. So Trump did come out and said that he was going to impose 100% tariffs on China. And this is what caused that risk off market during New York session on Friday, right? This is not the first time that happened. This is He did that multiple times in the past, if you guys can remember, right? So this is what really set up for those really good opportunities when it started leading to buys on that Friday, right? Very easy opportunities, and not just gold, right? Just looking at the chart of gold right here in a minute. One sec, guys. Yeah. So just looking at gold, right, hitting all time highs again. I'm gonna talk more deeper about why gold has been pushing in that direction too. But it's just not a coincidence, right? And then now, just going to show you guys a snapshot of the equity markets, right? You can just see this bearish price action that we have. That's just the uncertainty of the tariff headlines, right? When we see that the U.S. is having that beef with China, this is the reaction of the markets that we have to pay attention to. This is a complete risk off market. Okay, so every time you see those headlines, it's not going to be new, won't be a surprise. We already had it before. So if this does continue to pick up, if it does pick up, right, don't be surprised with the reactions. You should know how to take advantage of it right away. So if Trump ever comes out, it says that he is looking to retaliate or impose higher tariffs on China, causing that uncertainty. Just expect those same moves to happen again and again. Okay, it's not going to change. But why this happened? Trump accused China of seeking to hold the world captive with new export controls on rare earth minerals. Remember this is one of the reasons why like the U.S. is getting involved with Ukraine. They were supposed to sign that treaty. Well, I remember. You remember that they were supposed to sign rare earth minerals to the U.S. Right? That was supposed to be the reason of the U.S. helping Ukraine against Russia. But we all know that China holds more rare earth minerals over than the whole world, right? So this was the reason behind why it's happening. But ever since over the weekend, we saw them retract those statements. We see that there's headlines coming out now. Oh, we're still in a good, us and China, we're in good hands right now. We still have a strong relationship. And the meeting that Trump is going to have with the Chinese president is still going on. All right. So that alone is what I'm expecting now equities to pretty much recover the move, because all the downside that we had in the stock market was really because of this headline. And then now he just coming out retracting everything, saying like, it's not that bad. I was just overreacting. I was too emotional. And now I'm expecting the equity markets to recover those moves. So the reason why, we saw equities range today is because, it is a holiday, but it's not a federal holiday, but the bond markets was closed. So stock markets just ranged today, but I wouldn't be surprised if we do see again Nasdaq, S&P, and like the US 30 push higher, right? Because I would like to see those moves pretty much recover and push up. Because the reason for the downside from the stock market is pretty much out of the picture. There's no reason for it, right? So that's why I'm expecting that to pretty much hold. I answer your question right now with you think the government will open back up soon. So this is what we're going to talk about too. So will the government shutdown end? So far reporters said that they're expecting the Congress to come back to the office tomorrow, but around 6 p.m. So when they do come back, it all depends on what happens, right? But if they do come back, hopefully this would probably lead to optimism, right? Hopefully we could get more information like based off of when they finally come back into office. What's going to happen next, right? Because this is what's really impacting the markets overall. So we did have some headlines about this too, which I want to show you guys because it's important to pay attention to this stuff too. What was the giveaway? Yeah, because we can see here, this is the U.S. The Treasury Secretary. So he says that official Treasury data will come out when the government reopens. So when people is asking, oh, is NFP data this week? If they're not open, we're not going to get the data. But there is this sign of inflation, right? So right here, the BLS said that they are going Friday, October 24th at 8:30 a.m. This is where they're going to impose the CPI data. So is this a sign that hopefully they open up soon? But we also saw something from Goldman Sachs saying that this is going to be the worst lockdown ever. So we don't know. Right. But so far, the markets is not caring about the lockdown, but eventually it will. So I think we just have to be aware of that. Eventually, the markets will start to care, but they're probably not going to care like this instant. So it's just something that we just going to have to pay attention to moving forward. All right. So now let's move towards. We're going to talk about the macro. We're going to focus on the Federal Reserve, right? So you guys can start understanding the bigger picture and why. Just start here with the market update. All right. So looking at it from a macro perspective, okay. So understanding the direction of the Federal Reserve, what is their next steps, what is leading towards that step, and understanding why. Because overall, we're already seeing the moves play out. The markets are forward looking, right? This is why we see that the stock markets is at all-time highs. This is why we see that equity markets, like the dollar is already near all-time lows. So it's none of this is, the markets like to move pretty much 3 months ahead, right? So the markets are forward looking. The problem is with us as retail traders, we are always late to the party, right? And this is why retail traders are always in the opposite side of institutions, for hedge funds, right? This is why they say do the opposite of what retail traders do. And it's because when we're, just like all of us, we all fall for it, right? We are currently looking at data and charts at the current moment, the current price points. We're not thinking about like what's going on with data, with the bigger picture that is impacting future expectations, right? So the fact that we don't think that way, this is why we're always in an endless cycle, right? We're winning, losing, winning, losing, winning, losing, because we don't plan ahead. So doing this, right, having a macro outlook is planning ahead, so you're able to capitalize on the bigger trends. And then if you see any momentum shifts, you're able to understand why that shift is happening and then get back into the bigger trend, right? So this is what's really going on. Just like an example of earlier on this year, right? The markets already knew that the Feds was en route to start cutting interest rates. It's not a surprise because the debt to GDP is rising. It's been rising since 2024, right? We're literally at the high of the chart when it comes to the debt to GDP. In a private group, like when we start doing our thing on Friday, on our educational calls, I'll show you guys the charts and the websites. But this is just so you guys could get a better understanding. So the fact that we already see that, and what this means is that the debt is rising faster than the U.S. growth, pretty much, like the U.S. being able to pay back the debt. So debt is rising faster than GDP. So when that happens, right, this is going to pressure the Feds to cut interest rate to make debt easier for the U.S. economy, right, for the U.S. government. So the fact that this was already happening since 2024, right, and then when we see that happen, tariffs became a big issue, right? So what happens with tariffs? Oh, even though the Feds are cutting rates, we're like, oh, but cutting rates is good for the stock market. So how come NASDAQ, S&P, and the Dow Jones pushed lower from January to April, right? Because of tariffs. And then how come right after that the market still pushed higher? Because the expectations that the Feds are still going to cut rates eventually, right? Because all the data that we've been getting since like early on like pretty much 2024 till this year has been signaling that the Feds is going to start approaching their dovish cycle, even though they haven't cut rates yet. But they're not going to hike. And the reason we know they're not going to hike is because the debt to GDP is literally at all-time highs, right? And then also what we pay attention to is interest payments, right? We see that interest payments is also rising as well. But the website is down because of the government shutdown. But even the interest payments rising is a reason for the Feds to be pressured to cut rates. This is why Donald Trump calls him late pal, right? Because when you see the data of debt debt to GDP and interest rate payments, usually what the central banks do is start their cutting cycle to avoid that type of pressure. But the fact that Jerome Powell is still holding back, right? And I explain why he's holding back is going to be under policy positioning. But now, when we look at growth and momentum, so we already know that the Fed is in a cutting cycle because of what's going on with debt to GDP, right? So when we're talking about economic data, we can see that GDP for the US is rising temporarily, right? But ISM growth is falling. PMI data, we're slowing down. We're in contractionary, is below 50. And retail sales is rising. So when we look at that type of information, this is where when the Fed speakers is always saying, oh, data is showing it's declining slowly, but it's not recessionary because GDP is still strong. We see that retail sales is still high, which is also retail sales we know is inflationary. So this is why they're only looking to cut 2 more rates this year, is because we're not seeing a strong decline in growth data, right? And we're not seeing a strong decline in inflation. Now, when we look at inflation regime, CPI and PCE, it's cooling, but it's still sticky. So every time when we hear Fed speakers, they're like, yeah, inflation is coming down, but they're still concerned about inflation actually still rising. So they see the leading indicator of retail sales is picking up, so that impacts overall CPI as well. Plus housing, home sales is also increasing as well. So this is what's causing inflation to still be sticky. So but overall, still dovish Fed, but we can understand that it is not screaming recession. It is not screaming inflation is decelerating. So for you guys, that's anticipation of aggressive rate cuts. That's most likely not going to happen yet. So in order for us to get that, we know what to pay attention to. We need to see GDP pushing lower. We need to see retail sales coming lower, okay? Especially labor. So now when I was talking about the government, Dylan, well, great context, debt to pacing growth is another catalyst for Feds to be, exactly. So I'm glad that it helps. So now, what is the central banks doing? So did most of you hear about the Fed balance sheet, right? So this is one of the things that a lot of us just overlook because of the big words. They do it purposely, right? They give us those big words. They do it purposely. So they like pretty much so that we can be confused, right? They give us these big words. If you guys on Instagram, go to YouTube so you could get a better view. But they do these big words so that we just don't focus on it. But this is the stuff that institutions pay attention to, right? This is how we could determine the next step. So we paying attention to the balance sheet, right? It's still shrinking, right? But it's slowing. So they're still doing QT, but it's not, they're like pretty much they're taking money out of the economy, right? But they're not doing it at a fast pace. So liquidity is neutral, not draining fast anymore. Supports short-term calm in markets, right? So this is one of the things when it comes to the balance sheet. It helps us understand if the Feds is actually trying to stimulate the economy, right? If they stimulate, we know more money is coming into the economy that weakens the currency, right? If they take money out, right, that less dollars is in America, right? So that strengthens the dollar. So they're pretty much stable. So we don't have an edge yet. So this is why this helps, right? Because we see that they're actually trying to shrink the balance sheet, but now we see that it's moving sideways. So this is where we get the indecisiveness from, because we see that dollar is at all-time lows, but now I show you guys the 4-hour, dollar is just pretty much moving sideways, okay? Now, when it comes to the Fed policy, they cut rates once this year. They're in a slow path of rate cuts, but they're expected still to cut 2 more times this year. But with this government shutdown, depending on how long it lasts, right, that is what's going to really start impacting the market, depending on how long the government shutdown lasts, right? So obviously, we'll know when it actually start impacting the markets. You're going to know because the news, they're going to talk about it repeatedly. It's going to be a shit show. But one of the problems when it comes to physical policy, right? Large monthly deficits is negative $300 billion. The government is still heavily spending, right? Physical policy short term. Like, so pretty much this is what this means. That we're like pretty much an average every month, the government goes over $300 billion of what they bring in. So they have to grab that $300 billion from the feds. So short term, like this is pretty much what they're debating, right? And they're trying to like obviously when it comes to the government, what they've been trying to do with Elon Musk, right? They're trying to cut down that deficit. But the consequences of cutting down the deficit, right? That's what's going to cause problems with growth in the United States. So if they actually come to a budget and you start seeing that the deficit starts getting lower, right? This is if it comes down lower, the markets might take a hit because of that, because the government isn't stimulating the economy, right? But short term, that is a problem. If we see that the monthly deficit actually is lower. Right now, the deficit is still high. The government is still spending heavily. So that means they're putting money into pretty much what does the government fund, right? This is what helps the economy evolve, the government funding. So the more that they do that, it's good short term, right? This is what boosts the United States GDP. This is why we get good data for GDP. But long term, this is the reason why the feds don't want to cut rates aggressively. Is because the United States government is very lousy when it comes to their money. So pretty much there are like just an example with like human behavior, right? So imagine if all your bills a month is $10,000 a month, right? So your bills come out to $10,000 a month, but you only make $7,000 in your salary. So you have to get debt to pay the extra $3,000, and then you're doing it repeatedly, right? Repeatedly. So that's what the government is doing. So would you trust them? Would you put yourself in a position to cut rates aggressively? And the problem with this deficit is inflationary. So that's the problem that we're like pretty much that a lot of us as traders, they don't tell us this, right? So that's the reason why the Feds is not cutting. They're staying data dependent. They need more confirms. They're being patient. This is why they're not aggressively cutting rates, is because of how the government is handling the spending, right? But it's also bad for the government because the government cares for us as people, right? The central banks, they care about stability. They know that, people they're going to go through hell if that happens. But that's where you can see, if we see any headlines that the government is cutting spending, this means that they're lowering the debt deficit. That can impact GDP. So you can see at the top where growth momentum, where GDP is rising, that would obviously start pushing lower, but that would still be good for the Federal Reserve. That would make the Federal Reserve want to cut interest rates. Okay. So that's the problem. So that's the bigger picture. All right. So when it comes to capital flows, we can talk about that. Yeah, I don't have to know about that much. We can already see how the markets is reacting. Now, when we look at big economic data, right? So we already see that the Federal Reserve is cutting interest rates, but they're doing it at a slow, gradual pace. So what that means is no reason for the dollar to continue bearish overall. Like dollar is still bearish, like macro, but there's nothing triggering right now for dollar to be aggressively bearish. So this is why I see right here my bias is neutral when it comes to the dollar. But a dovish central bank, that gives us bullish for gold, bullish for equities, right? Because we know that the Federal Reserve is going to cut rates next. So this is what gives us that direction, okay? So what could change that outlook? So that's what's important, because we already understand now the bigger picture of the central bank, of the Federal Reserve. We know that they're dovish, but they're still data dependent. Okay, so what could actually trigger recessionary risk? That is going to, a recessionary risk is what's going to confirm rate cuts, faster rate cuts. What's that? All right, should be better now, right? All right, hopefully I'm better. All right, so when it comes to recessionary risk, that's what's going to change the outlook from them being cautious, data dependent to cutting rates aggressively. It's recessionary outlook. So if we see ISM data like PMI data staying below 50, also if we get NFP data that actually still come out worse than expected, right? That's when we're going to start seeing recessionary risk. Okay, when we start seeing a trend of growth data declining very aggressively, that's going to be something where we're going to be expecting aggressive rate cuts. That's going to be a reason for an aggressive dollar to push lower. That will signal for gold and equities gold to push higher, but recessionary risk is going to be bad for equities because this is the caveat, right? People misunderstand this. Even though the feds are cutting interest rates, it depends on why they're cutting interest rates. Okay? Why they're cutting interest rates. If they're cutting interest rates because of what's going on now, which is inflation is still lowering, growth in labor markets are lowering, but is still strong, right? This gives them the breathing room to still cut rates because of lower inflation. But if they cut rates because they are afraid of recessionary fears, then that's different. It's kind of like, oh, we're cutting rates now to bail your asses out, right? Oh, we got to cut rates now because shit is going to hit the fan. So when the markets see it from that perspective, that's when the equity market's going to free fall, even if they're cutting rates still, even if there's a 50 basis point cut, right? That would still cause equities to push lower because they're cutting rates because of recession. So that's like a actual change that you look out for. Another change to the outlook, right, is if inflation rebounds, right? Because there have been temporary, they expecting inflation to rise, right? But they don't know obviously how high inflation is going to go. But if the yearly PCE or CPI, right, core goes above 3%, that would definitely stop them. They're not even going to think about cutting interest rates. That's going to make them pause, right? So they're going to stop cuts. They're going to pause rates. That's what's going to cause dollar to rise. We're going to see gold push lower and equities push lower, right? So that's the next step. What we're currently seeing now is the perfect soft landing, right? So if everything stays steady the way that it's been so far, right? We get bad data, we get good data the following week, right? We're just going to see the markets continue the way that it's going. You know, like this is what this is what's currently it's been going on this time is the last scenario of the perfect soft landing. That's what's been going on recently, right? So if data continues to stay the way that it is, this is the direction that we're going to go. Okay, so that this is where like we could get the understandings on what to expect next. Okay, so this is what really helps with that bias. So now this is like the weekly checkup, you know, but I'll do this with the private group. So now I'm gonna go back to the weekly outlook. All right, so does that make sense so far, guys? Put a 1 if it clicks, right? You should understand why the central banks are dovish. You can understand now what to expect next, right? You could expect moving forward. So the problem is, right? They understood this months ago. This is why dollar has been pushing bearish this whole time. This is why equity has been pushing higher this whole time. This is why gold has been higher this whole time, on top of everything else. But they understood this months ago. So that's the difference, right? You want to learn swing trading. You want to learn how could I hold my positions? How could I trade along with the central banks? Is understanding this stuff, pre-positioning, right? Because the data is what signals us, right? So just like an example, if I just go back, right? So if any one of these scenarios happen, right? If we see that, if they ever open up and then we see NFP numbers come in extremely bad, which direction you're going to go with the dollar, right? You're not going to wait for the rate decision to say like, oh, they're going to cut rates. Let me short during the rate decision. They're going to start reacting now, right? So that's the difference, you know? So that's what I mean by we're always late to the party. This is what they say. So now when we do the weekly prep, right? So understanding the bigger picture. So this is just a quick snapshot. So the current market tone, soft landing, dovish bias, okay? So growth is slowing, GDP, inflation is sticky, right? Fed is neutral to dovish. So this is what I meant. This is exactly where we are currently. So investors are cautiously risk on, positioning with slower growth, steady earnings, and gradual easing. So this is just a snapshot of it, so you guys can get the idea of what's currently happening. Like right now, there's always a transitional phase. There's always a cycle. We're heading towards a dovish cycle, but right now we're at the transitioning phase. This is why, sometimes the markets look confusing from a fundamental standpoint, is because we're dealing with the transitional phase. It's like how we are risk on market if gold is pushing higher, right? So that shows that we're in a transitional phase. We just have to wait until one of those things come out, then we can move to the next phase of the markets, okay? So economy cooling, not crashing. So we just went over that. So when it comes to growth, right, this is why we have to track data. And there's websites where you can get this information for free, right? But you have to track data. So far, we can see growth still expanding, soft landing intact. So inflation is cooling, right? Limits fast rate cuts. So that's the problem, is inflation. So we have to pay attention. What is it? When I said October 25th, so that's when we get CPI. That's what's going to give us an edge, okay? So that's why we need to lock down the end, so we could understand what is the Federal Reserve going to do next? What is this data going to do, so we could get an idea on how to get ahead, how to look for opportunities moving forward, right? So policy, we know, is dovish. Liquidity is steady, no tightening pressure, right? Now, when it comes to just a weekly bias, right? So overall, when it comes to the dollar, I'm still bearish because of the overall sentiment. So the trend of the dollar to me is still bearish. But for since the lockdown, I could say we could see temporary bullish price action for the dollar, which we already got, right? And it's because the lockdown, right? So it makes sense ever since the rate decision, we see dollar pushing higher because the markets already knew the Fed was going to be cutting interest rates. But the fact that a 50 basis point cut wasn't on the table, that was a disappointment for the markets. So there's no reason to aggressively cut interest rates if they know that is no point for them to want to continuously sell the dollar if they already know that a 50 basis points wasn't a conversation for that rate decision. Okay, so that's why now I'm more for short term. I like dollar strength because of the lockdown. Because data can't help the Feds stay dovish, okay? And then also dollar is a safe haven. So when we have the uncertainty, we got the reason for the lockdown and the uncertainty to give us temporary upside, but I'm still macro downside. But this is what I meant looking at the, where is this at? When we said looking at the dollar, right? You can just see that we're moving sideways. This is because of the balance sheet being steady. This is because the Feds is not overly dovish. They're not aggressively dovish, but they're still slightly dovish neutral, right? And we're not having upcoming economic data confirming rate cuts. So this is the reason why when we look at the dollar, it's just been ranging. So does that make sense? So you can intraday trade it, right? Trade it when it's data and all of this stuff. But we need to see what I showed you guys in the previous is that in order for us to get a trend like this, we need to see one of those shifts happen. So when that shift happened, like higher inflation or bad NFP numbers, that's where you're going to get that break of structure. That's where we're going to see the break below support. you're going to be able to take advantage. You're going to see the breakout higher. If higher inflation, you're going to see dollar rise. So that is what's going to really impact the market. But when it does, you guys will know why. So that's the clear picture. Okay. So that's where like so far when it comes to the dollar, like just temporarily, I like upside, but I'm neutral. Like why try to force a trade if there's no data, right? So it's like if I know what drives the dollar and I see that the Feds is not doing much, like this is why dollar and gold is rising, right? So we can see that dollar is rising as a safe haven along with gold. But this is where it's okay to be patient until all of this nonsense settles so you guys can start finding an edge, okay? So that's the whole point. When it comes to gold, I like the idea of buying dips. Like that's like shit. You don't even have to know about the markets. You can just buy gold and you've been profitable. But at least we understand why gold has been pushing higher, right? Because of weaker dollar, dovish Fed, war tensions was happening, all the uncertainty, the buying power of the central banks buying gold repeatedly. So all of this stuff is helping gold push higher, right? So that is still there. Like we don't have no reasons to sell gold unless we get higher inflation signaling that the Feds should pause rates longer. That will be probably the only reason I will look for to really sell gold long term is a hawkish Federal Reserve. Other than that, really no reasons that we can find to sell gold other than profit taking. Maybe if we see it just has to be higher inflation where the yields rise and the dollar rise. And then most likely profit taking, okay? But other than that, gold has been a better buy, right? So if you can just have to be patient. Every single time we see gold give us a pullback, right? We just start following that trend higher. You may get messed up 1 or 2 times, but eventually you may catch that trend of gold continue to push higher. All right, so that's the bigger picture. When it comes to equities, same scenario. When it comes to equities, right? There is nothing that is happening with the equity markets that is signaling that we should be long-term sellers. But the reason for me to want to sell equities will be different than gold, right? It would be because if we see recessionary fears, that will be a big catalyst to sell gold, right? If we see bad NFP numbers, horrible job numbers, bad growth numbers, that's what's going to be a catalyst for us to sell equities is growth fears, okay? That will be one of the pretty much the only catalysts. Or if we get a hawkish Fed, okay? So those would be the 2 reasons that we look for. But as of right now, when it came to this bearish move, that was because of Trump-China tariffs. We're probably going to see this move recover because there's really no other reason, right? Maybe if the lockdown shows that the lockdown is going to be longer than what people anticipate. Once equities react to that, that's probably going to be the catalyst to react to sales. But so far, the markets is not reacting to the lockdown because obviously the lockdown is political and it's temporary. So if they last for a month, they're going to have to open back up eventually anyway, right? So that's why it's not really a care in the world when it comes to the markets, okay? So lastly, we're going to talk about earnings, right? So just so you guys can understand why earnings is important. And we got bank earnings starting tomorrow. So bank earnings set the tone for the entire earnings session, right? We understand how banks are. That's where everybody got their money at. That's where everybody get their credit, their loans, businesses, right? So if banks show strong profits, right, pretty much this helps investors gain confidence in the economy. So if the banks are doing well, investors are more confident, okay? So, but if we get weaker results, right, from banks, if we see very bad earnings tomorrow, this week from banks, that's going to show a possibility of slower growth and tighter credit. Banks ain't taking loans out, right? That's bad for the stock market, okay? So that's the little indicators that we have to pay attention to understand forward guidance, right? So when you see it at the stock market is pushing lower, right? And it's earnings came out. You don't understand why. And then a month later, we start seeing GDP is becoming an issue. It all started because we see that earnings actually came out bad. That was the first indicator, right? We already got a temporary slowdown from GDP. We're seeing decline in labor data. And then now, if we see that banking earnings are declining, that's a trend of data showing more fear in the economy, right? So like I said, if the market starts selling off because of that, they're not going to wait for the rate decision. They already know that, oh, this is what's going to cause the Feds to want to cut interest rates. So this is why they're always ahead, months in advance. All right. So that's what we pay attention to. But bank earnings show whether consumers are spending or struggling with business, or rather if businesses are still borrowing, right? So this is where it's going to be important. We got BlackRock, J.C. Penney, Gold. We got the big ones tomorrow. So this is what's going to be important. And then Wednesday, we do got Bank of America, Morgan Stanley. So credit. American Express is on Friday. That's more for like consumers. But pretty much tomorrow is going to be the big picture. Okay, so that's what helps. But if it comes out, if earnings tomorrow still is positive, like and it's at the open too, which is going to be good. So it's at the open, so it's still going to be positive. We get some positive earnings. That'd be another reason for equities to recover that move from Friday. All right, so that's what really helps you guys pretty much find an edge in the markets. So look, this was quick. But if you guys have questions, put a 1 if you guys are good, if everything is clear. If you have questions, now I can take questions to help you guys out. What's your thoughts on robots? You mean like algorithms? I mean, if you like they all use them, like that's the problem too. Is like they all use the AI, right? They all use algorithms to help their trades, but the algorithms understand the cycle. So this is how they stay ahead, right? They understand the cycle. But the problem with the AI, right, is black swan events. Like when it came down to like when COVID happens or when the tariff situation happened, like would the algorithm repeat for that, right? So that's the only thing I don't like is that when we get a black swan event, like you're going to have to adjust to that yourself or hold through it. Like that's the downfall of that. Dylan, you good? Yeah, how many of y'all called gold buys though? I think that was a really good trade, But yeah, like so we're gonna go live, guys, to the private group for the Bank of England's labor data tonight. So we can talk about that too, right? You still got a small run of gold. Good job, Dylan. So when it comes to the UK, right, we can find an edge when it comes to the UK now. Because this report, when it comes to labor data, right, it just shows how strong or how weak the UK labor market is. So very simple. But this also helps for what the Bank of England is going to do next regarding rate cuts. Because the Bank of England is still very restrictive. And when we've been tracking so far leading indicators for this upcoming labor data, we see that vacancies has been falling, right? Companies are hiring less. We can see unemployment has been slightly higher, right? So we got the job market cooling for the UK. Wage growth is slowly down, less inflation pressure, right? But jobless claims is starting to rise. We're seeing early signs of weakening. So this tells us that the labor markets is cooling. It's not crashing, just like the Federal Reserve, okay? But the Bank of England is watching this labor print. They are watching labor data. So the problem is, why isn't the Bank of England in a cutting cycle? Is because, like the labor data is cooling, but inflation for the UK is still high. So they don't want to cut interest rates, even though, if tomorrow morning's print, if unemployment does tick up and we see that, we see bad labor data tomorrow, I will expect a weaker pound. But will it change the bigger picture? So this is why, when we see data, bad data, you take a sell in pound GBP JPY, and then the move recovers 3-4 hours after. It's because the better opportunity will probably be a strong print because that's going along. That will be a surprise, but that's what would keep the Bank of England hawkish. That's what's going to keep the pound stronger. What would help is if CPI was weaker first, and then we get a weaker labor data, because that's a trend allowing for the Bank of England to want to cut interest rates. That's what would help for that pound currency to remain weak. So if we get weaker data, right, if this happens, if it confirms that the job markets is softening, which will be bearish for the pound currency. If wages stay high, right? Because we get wages is inflationary. That will be bullish pound because it means inflationary pressures is high, right? So the problem with the United Kingdom is inflation. Like the problem with the US is what? Is labor, right? So labor inflation is already dropping for the US, but labor markets is strong. So that's what's stopping the Feds from cutting rates aggressively. The Feds of the Bank of England, sorry, what's stopping them from cutting aggressively is inflation because labor data is dropping, but inflation is not dropping. So that's how you're able to catch an edge. Okay, so we're gonna be trading that live tomorrow. So if you guys are interested in trading live, right, just go to the link in my bio and join the private group if you guys are interested. But again, thank you guys for showing up and listening. Like I understand, like this information is, it may seem like a lot, and it's like, why would I want to waste my time learning this? Will I ever learn this? You will. You've already been proven to yourself your whole life that when you start something, you don't get it, you always end up getting good at it, right? This is what's going to give you an edge in the markets if you take it seriously. Because I can confirm to you, this is how you can stay in the right direction. So the only thing that you would have to work on is your risk management, maybe your psychology, maybe your patience. But understanding what moves the markets, that's no longer hard. You figure that out if you pay attention to this stuff. Then when you have to work on, oh, how do I get for trades? That will get better because now you can understand the direction and you can understand why. Because if you're just excluding this stuff and I'm just looking at gold, right? And if I'm just looking at charts, right? Every opportunity to look up like an opportunity. Like there's probably people selling here, don't know why. There's probably so many people selling here, they don't know why. There's probably people probably bought here, but closing that drawdown and don't know why. But when you understand the bigger picture, you know that, oh, I understand what's causing gold to rise. So why would I be looking for sells on gold if there's nothing really signaling that I should sell gold right now, right? So this is why the markets is one-sided. This is why equity markets is one-sided. Why would you sell the stock market if there's no reasons for you to sell it? But first, you have to understand the reasons. Make sense? Y'all picking up what I'm putting down? Right? You got to understand the reasons. So once you understand the reasons, this is where trading gets fun. This is where, oh, it makes sense. This is where it feels not like gambling, right? This is where it feels more interesting. So this is why this was my missing piece. You get what I'm saying? Like this was my missing piece because I started out just only looking at technicals. Never found an edge, but finding out, like you just see nothing but people on YouTube always killing it for somehow. But it's like, yo, I'm trading just as much as you. Oh, but if you could show a $30,000 win, like, damn, what does your losses look like, right? So it's like if you're just buying and selling, you don't know why the pairs are moving in these directions, right? How could you be consistently profitable for years to come? So when tariffs happen, why tariffs is hard for a lot of people is because they don't understand risk sentiment. They don't know, like, why are they not catching the buys in the equity markets? Because they don't understand the bigger picture of the Feds. So this is where when you understand this stuff, it helps you have an edge in the markets. It also tells you when to stay away. It also tells you when you can look for trades, right? All of this stuff helps, okay? And this is how you can remain consistent. Now imagine if you take this information and apply it just as long as you have learning all the other dumb shit. Excuse my language. But imagine what type of person or type of trader you could be, right? But it's just like, I love this. If you love it, you want to be great at it. In order to be great at it, who are the people that are great? The billionaires, institutions, right? The CEOs. Like most people don't even know who Ray Dalio is. Most people don't know like most of the hedge fund owners' names. But these guys are billionaires and they follow all of this. They don't do nothing. This is what they follow and this is what they track. And that's how they're able to stay in the game for so long. Okay? Can we see more of this every week? Yeah, it's on like Sundays, Mondays. When you go to my YouTube, just hit the notification bell because I can't really give a time when I'll go live or not. So just hit the notification bell. Kalaj finally got buy entries on NAS at 24.76. Hell yeah, man. Yeah, I definitely think this move is going to recover. Tyson, what's up, man? Yeah, I feel like this move is gonna recover. My opinion. The only reason why I don't think Nasdaq recovered today is probably because of the holiday. Of like, but it's just yeah, I believe it's just the holiday. That's the only reason why I don't. It would kind of suck if it recovers today, but it'll be great, right? Because it's expected. So if you're in those buys already, and we can see if Nasdaq does recover this move, and then lead into tomorrow earnings, if the bank earnings does come out positive, oh man, this is going to skyrocket. We're going to probably see equities hit all-time highs again. Yeah, so that's what I'll definitely look forward to that. All right, guys, I appreciate y'all. Thank y'all for being here. Again, if you got any questions, don't hesitate to reach out, guys. Have a good one. I'll see you guys. London session private group.